Hello, everyone. Welcome back. This is managerial economics. Well, this week we're going to go into chapter 2 to talk about fundamental economic concepts so that we can actually gain some grounds to have further discussions in the next couple of weeks. In chapter 2, we are going to go back to our fundamental Econ 101 supply and demand model. Revisiting the model and help us to understand how businesses make their decisions. And then we will spend some time talk a little bit about the different types of analysis, particularly related to how managerial decision is being made. For instance, like the marginal analysis, how to calculate the net present values, how to measure risks of a business, and how decisions take into considerations of the risks of the business and the returns required for running the business. Well, supply and demand simultaneously determines the market equilibrium as we study in Econ 101. The market price usually represents the market equilibrium price, which is a compromise price between the supply side and the demand side of the markets. So when the price is committed, well, the willingness to pay in the market is basically under the price consumers are paying. And when the price is above the minimum cost to cover in the business, then the price will also be committed. So in addition, the supply and demand are explicit rate per unit time period. Like for example, we can think about auto per weeks that produce at Chevy dealerships and the aggregate purchase intentions of the households in the surrounding target markets. Market price is a projected market clearing equilibrium concept, which means a price that equates the flow rate of intended purchase and the planned sales by the firms. Well, as many of you actually have seen this graph before, looking at the supply and demand plots, we can easily find that equilibrium place where two lines are met. At this equilibrium price, again, the concept is basically where the buyers and the sellers are committed to that one price of the products in the market that actually drive the clearance of the inventory of the goods. However, there are many different contributions to this supply curve and demand curve that shaping the curve differently. Some of the key concepts that you might want to revisit are the following. Diminishing marginal utility. So the diminishing marginal utility is a concept that describes how consumers are it's ranking the product in the heads and trying to find a relative price that actually most reasonable for them to purchase the goods or service. When more of the same good is consumed, the lower the utilities that we think that we're gaining from that particular product. And as a result, the demand curve is actually downward shaping, mainly because, well, everyone think that, well, eating the first burger, it's great, it's worth $10. Eating the second burger, it's good, it's worth $8. But the more you eat at that particular point of time period, the lower additional utility you will get back. And that's where the diminishing part is coming from. And as a result, the higher quantity of the goods it's being consumed in the market, the lower the price is required for people to purchase that amount of goods. Similarly, we have the concept of diminishing marginal returns, which is mainly describe the cost side of the product. So the marginal cost in the production usually will be increasing. As many of you actually remember, there is a marginal cost curve study in Econ 101. And the main reason for that is because as more of the same product produced in a particular manufacturing setting, the higher the cost, additional cost, right, marginal cost will involve. And even though when we are trying to adjust the production inputs, for example, like labors or capital, but we are always bound by some fixed costs or fixed variables, fixed productions factors. For example, like the size of the factories, we can continue to increase number of people working in the factory to drive more efficient work, divisions of work, or specializations to lower the cost. But at some point, when we have 500 people or 1,000 people working in a very small, tiny factory space, they are basically just packed in a small space that preventing more efficiency can come out from that particular site. So this marginal cost concept, it's a fundamental idea that driving the supply curve in the markets to be upward sloping. There are many things that we use to describe the supply and demands in the markets, and one of the particular type or maybe the tools that we use is called the demand schedules. So the demand schedule, it's basically the tablet formats of demand that shows you the quantity being demanded in the markets versus the price at that particular quantity demanded situations. Again, back to Econ 101, there are many attributes to the demand functions or um, driving the demands, right, in the market. When we say driving the demands or maybe shifting the demand curve or maybe changing the demand of a good, we are literally thinking of the demand curve is shifting either left or the right. So for example, the price of the good itself, it's not a shifting factor of the demand, so it doesn't shift the curve. The price of the good itself basically affects the quantity demands of the goods. However, the price of the substitute goods or complement goods, they are the shifting factors of the demand. The income of the populations in the markets also is a shifting factor. The size of the market, how many people exist in the market, tastes and preferences, the expected future price of the goods change. All of this are basically contribute to the shift of the demand curve, or sometimes we call this the change in demand. Here's a list of the determinants of demand. Again, those are the fundamental factors that we study as economists to find out why something is getting more expensive or being demanded in the markets as comparing to different time periods. So the concept here, again, shifting the demand curve, it's not associated with the vertical attitude change, but it's more fundamentally referring to the left or right horizontal shifts of the curve. On the other hand, supply also have the similar factors that actually changing the supply of a goods. For example, the price of the production inputs, the price of the unused substitute inputs, the technological improvements, the number of sellers exist in the market, the costs for complying some sort of regulatory compliances, tax, also expected change in prices in the markets in the future. So all of this are basically what we call the determinants of supply or the shifters of the supply curve. So again, the concept here is the supply curve will be shifting either left or right based on the change of these factors in the market. But keep in mind, the price of the product itself, it's never a shifting factor of neither a demand or supply of the goods. The price of the product, it's going to affect the quantity demanded of the goods or the quantity supplied in other goods in the markets. Again, there's a table of a list of the supply factors that shifting the supply curve either left or right. Here's an example of the price of gasolines from the year of 2005 to 2011. So at every single point of time, as you can see, there is a price that is committed in that particular month in this case, right? So we have 12 months in a year, and each bar represents the price of gasoline in that particular month. So you can literally tell that at certain time of the year, the price of gasoline will be higher as comparing to the other month. And obviously, the intuitive reasoning here is that in some point of the years, people will have to consume more electricity. And when they usually do, well, as you can observe from the graph, neither the summertime or the wintertime, right? So either people are turning on their AC or maybe the heater. Those are the basically the most demanded periods of gasolines or maybe traveling, right, in the summer, where the gasoline prices will be demanded the most. And as a result, the price of, or the equilibrium price in this case, will be higher in those periods. So crude oil prices also have some fluctuations in the markets. As you can tell from this plot right here, where we are looking at a very, very dramatic change of crude oil prices in 2004 to 2010, and mainly because of the Iraq War after that, where the supply of crude oils imported to the United States has, or maybe not just the United States, but the worldwide, has changed dramatically. So because of the change of supply, in this case, the supply curve shifting dramatically to the left, and affecting the oil prices or the crude oil prices in the international markets to be at a higher level. And you are seeing this equilibrium price in the year of 2004 to 2010 has jumped dramatically to from about $40 or maybe $35 all the way up to $130 in the year of 2008, and then come back down to the $40 range in 2010. So the reason why we are talking about supply and demand is because we want to always keep in mind every business decisions are based on the fact that whether there is a market to do business. And the markets, it's always represented by either the supply side or the demand side, right? So there's never one market where supply actually represents the whole market or the demand represents the whole market. There are some cases that we will study later to talk about the monopoly case, which is one supplier supplying the goods to the whole market. But again, if there is no consumer, even with the monopoly firms, there is no market to be defined. So talking about business decisions, most of the time people confuse about how decision is being made or at what magnitudes it should be made. So in economics, we actually define economic decisions or business decisions at a marginals. So we don't think most of these business decisions is made by just saying either we do it or not, or we are all in from our resources to achieve one project, or we put all the resources to another project. But we are mostly thinking about allocations of the resources at the marginals, right? So how much we should be spending on developing a product versus how much resources we should spend on marketing, how much resources we should spend on managing our finance in the company. So all of this are basically what we call a marginal analysis. What resources should be used, it's based on what the marginal benefits we can get out from those resources and how much does it cost us relatively to other factors in our business decisions. So the long-term investment decisions or the capital expenditure also are made by using the marginal analysis decision rules, where the marginal benefits is equal to marginal cost. This is the golden rule of thumb, where the profit can be maximized, but only if the expected return from the investment project actually exceeds the cost of the funds. Then, well, the project will be considered to be profitable. Otherwise, the project should be undertaken, right? So talking about marginals, again, going back to Econ 101, most of you already have a concept about marginal costs, marginal revenues, and of course, marginal benefits, which is marginal profits of a firm. But to have a little bit better idea about how those number is associated to each other, you can look at this particular example here. The table here actually represent 4 columns. The first column represents the number of units of output that the firm produced or sell in the market. The second column is the total profits earned from that particular unit sell in the market. And the third columns represent the marginal profits, how much additional profits we can get out from selling one more unit of the product or service. And the last columns there represent the average profit, which is the total number of profits divided by the total number of outputs sold by the firm. Well, in this case, you can totally see how the total profits most of the time does not speak out the true story of the firm, right? So when you are making decisions, you look at, oh, the business will lose $200, $150, or $25 when the firm's selling 0 unit, 1 unit, or 2 units in the market. But that's not the story that is good for your decision making, because how you want to determine what is the maximum amounts of output to produce to maximize profits, you probably care much about the marginal profit in this case. Well, selling one more, how much additional profits the firm can earn. And that basically is the fundamental idea why this table here is so valuable. Because if you look at it, at the beginning, it doesn't seem like the firm is getting much out of the productions, particularly if we look at 0, 1, 2, 3 units of productions, the firm actually getting negative profits. So does that mean the firm should never produce the goods? And the answer, of course, is no, right? So we want to actually look at the marginal profits. If the firm continue to produce more, how much additional they can get in returns. And in this case, the firm can continue to produce this good until unit number 9, where the firms actually earn $25 additionals more from producing that units in the market. But the firm will never consider producing the 10th unit, and the reason is because producing that 10th unit will start reducing the total profits of the firm earns in the market, which is counterintuitive. There are some visualizations in the Econ 101 textbook that might actually help you to understand the profit maximization rule, or maybe the optimizations concept here. But the general idea is, if we are running a business and to seek for the profit maximize points of output of the company, we most likely will care about the marginal cost and the marginal revenues for selling the goods. And again, just back to the golden rules. The golden rules here basically suggest, if you have a situation where the marginal cost is almost equals to marginal benefits, right, which is the marginal revenues, and that could be the break-even levels of outputs that you want to produce as a firm to maximize the profits. Otherwise, producing anything more, the cost or the additional cost will be higher than the additional revenue, and it actually makes the company earning less profits in general. Well, another very important thing to note is that most of the time when company investing their money into projects, um, for example, like starting a new production lines or develop a new products, or maybe putting human resources to develop a software for service based subscriptions. Um, all of this involve times to develop, produce, and plan, and the revenues may not comes into your company immediately after you have determined to go with the project. As a result, when managers they are making their economic decisions for the business, they usually don't consider the what the revenues looks like right now, or what they plans to earn in the next 3 months or 3 years, because well, those values are not comparable to today's values of the dollar. So the idea here is instead of just looking at a project and assuming that, well, 1 year later, when we start selling the goods, we are going to get $1 million back in revenues. But we want to ask the questions, how much of that $1 million in a year later will worth in the present values? How much does it worth nowadays? Um, and because of the depreciations of dollar or inflation in general, the dollar earned 1 year later definitely will have less purchasing power comparing to today's $1 million. And to calculate that, we can actually apply some very simple mathematical process to calculate the present values of a specific project. So given an example here, let's suppose we have a piece of land near a proposed new highway interchange. So it's a 1 year investment. The current value of the project is $1 million, and we're expecting the future value to return $1.2 million in this project. So that means the expected future profits will be $200,000. Sounds pretty good. And there is a alternative investment that actually provide us with 3% returns a year later as well. So let's say, well, there are two options here, and as a manager, I have to make a decision. Should we invest our $1 million into this highway project, or should we actually fund this alternative investments returns? The way how we are going to determine this can use the following equations. So in this case, we are considering there is a discount factors in this 1 year time period. So this discount factor basically means that, well, 1 year later, the money will, with no risk, to increase by 3% if we invested into the alternative investments. However, because we want to compare the two head to head, let's suppose money is going to grow 3%, or maybe 3% later, discounted back in 1 year, which is today, it will be less than 3% of worth. In this case, we can actually use the present value calculations, which is present values equals to the future values times the future value interest factor. And in this case, the future value interest factor is using the simple calculation 1 divided by 1 plus 0.03. And using 1.2 millions, which is the expected future value earned from the highway project, times the interest factor, and we will get $1.165 million. And this is basically the present values of the project. Consider if we are going to see money to grow 3% 1 year later, right, into the future. You can also do the calculation in the reverse way to basically ask the question, what would be the net present values if we are going to fund this project and getting the money 1 year later? How much that $200,000 will worth that for today? So in this case, we're using the $1.2 million, which is the present values of future returns, times 1 over 1 plus 0.03. And then we use this present value future returns minus what we initially invested to this project, which is $1 million. And in this case, the 1.165 million minus 1 million, we have now $165,000. And that's basically the net present values return from this projects 1 year later as of today's purchasing power, because assuming the money is going to grow 3% for whatever situation that could be. So using this example, you can simply think about if we are adjusting with inflations, right? 1 year later, instead of using the 3% as an investment return, we can actually replace that number with any inflation figures in the current state of the economy. So, for example, if the current state of the economy has an inflation of 5%, then you can replace the 3% with the 5%, and assuming money is going to depreciate 3% a year later. So how much that money actually worth for today if we are investing into this project? Well, another example here, basically just for the comparison purpose, when the project goes into 2 years, and how we are going to calculate the compound valuations by taking the square of that present value interest factor in our calculations. And of course, you can continue to ask the question, what about the project goes into 3 years or 4 years or even 5 years? And the things that you need to do, it's basically compound the interest factors by the power of the terms. So what causes some projects to have positive net present values, and what causes some of them to be negative? So when the products and the factor markets are often perfectly competitive, it is possible for the firm to earn above normal profits, or what we call the economic rents, as a result in positive net present value projects. The source of the positive net present value project includes the following barriers to entry or maybe other factors in the markets. For example, number one, we have the buyer preferences change or established brand name, so that people think the brand is actually well qualified, has a good quality, or maybe it has a good reputation, it has a well-developed cultures, like environmental established. People actually prefer buying more of this brand, then it makes it easier for the firm to earn a positive NPV. Number two, ownerships or control of favorite distribution system, right? So if you're taking a control of a distribution system, for example, you exclusively have the ownerships of the auto dealerships, or maybe the airline hubs that dominates a particular locations, that you're basically earning all the businesses within a geographical locations. In those cases, again, it makes it easier for a positive net present values returns. Patent controls, or maybe any specific production techniques or technologies designs that it's not easy to be replicated. Exclusive ownerships of the superior natural resources. For example, some company owns a mine of gold, then obviously this company might have a better hands to mark up their prices in the market. Inability of new firms to acquire necessary factors of productions, for example, like management, labor, equipment, superior access to financial resources at a lower cost. So company that taking economy of scales to lower the cost, attract capitals. Those are the ones that, again, most likely to have a positive net present values. Taking economy of scales in production, distributions arising from, for example, capital intensive production process or high initial startup costs. Those are the particular barriers that keeps competitive firms entering the same markets, so that the firm will have a better positions in the markets to fight for the profits. Now we talk about how the marginal analysis is being considered in economics, and also how we defined those net present values in returns. Risk, it's basically another big topic in managerial economics. Particularly, we think about risks that associate with almost everything that we make in decisions. One particular thing that you can imagine is that when you have 5 different projects in front of you, each of this project might involve different returns, and each of this project might also associate with a particular types of risk. Taking an example like a construction project, you might actually face the risk of rising material prices, increase of labor costs, or maybe sometimes postponed projects by the government's licensing. So all of this are basically risks to take when the business take on a project. Another types of risks that you can imagine is to develop a new software product that involve a lot of human capitals, software engineer, computer scientists, all this human resources pour into the products that might pose a very high initial cost of the company that they might not even be able to retrieve those costs after the product or the service is launched. So every decisions, every projects, every operations has different types of costs. The most effective ways to determine or demonstrate risk, it's basically using a probability distribution approach that you can kind of take into account of the historical cases and look at it more objectively, so that you can determine whether the risks are high or low comparing to the other related projects or operations methods. So generally speaking, managerial decisions can be made based on 2 particular determinations, like objective determinations or subjective. So the objective approach, just like how I described it earlier, you can look at the expected returns of a project, or maybe the expected cost of operations, and look at the historical data and form a distribution to see, well, 10 out of the 20 projects will have a loss, and 5 of the same kind of projects out of the 20 will have a net, and then 5 out of the 20 will have a positive returns. In this case, it's easy to see that the chance of success in this particular types of projects will be somehow relatively low, versus if you have a investment projects that usually returns like 3 to 5%, right, most of the time, where sometimes this similar kinds of investment project might have a loss, but it's a very, very short tail, like 1% of a chance, but majority of the time they will earn high incomes returns. Then you will be able to tell the distribution has a lower risk on this kind of a projects to lose money. So the general idea is basically apply a statistical approach to evaluate the risk of a decisions in the business. And of course, combining all this different analysis, or maybe future present values calculations and risk determinations, we are basically focusing on just one thing, right? So what could be the potential returns if I'm going to make that decision today for the company? And it all nails down to this simple relationships where the required return of a project, it's literally just a risk-free return minus the risk premium. And what we define as a risk risk-free return, it's basically any returns from your investments or your resources that has no risk that can be posed for the business. One easy way to think about a risk-free returns is to relate what you can do with your capital nowadays. For instance, an easy way to think about risk-free return is using the U.S. Treasury bills rate to think about the returns in the future. For example, if the U.S. Treasury bill offer you a 3% for a short-term or maybe the medium terms government security, 3 or 5% returns, and you know by the fact that the U.S. government is going to pay you the money back after the security is matured. And that's a guarantee returns. And that's basically what we call a risk-free returns from your investments. On the other hand, you might also want to think about what are the risk premium factors here. So the risk premium factor is basically the risk that we talk about, right? So every single project has a particular types of risk to lose money or maybe net or maybe earn positive income. So if the returns, risk-free returns of your project is greater than your risk premiums, well, in this case, obviously, you would like to go ahead and take that project and fly it. However, if the risk-free return is lower than the risk premium, in this case, you get a negative terms for the required returns, then obviously, in this case, well, it doesn't really worth your company or maybe your final decision maker to basically come down to the letter and take that risk on their own. How we are accurately calculating the risk premiums and risk returns are very different in different industry as well. So it nails down to your domain knowledge of running the business or the company operations and trying to conceptualize or sometimes needs to be quantified those costs so that you can compare to the returns of the projects.